Good morning, everybody. It is Monday, March 17th, 2025, St. Patrick's Day. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Investment Advisors. This is my weekly macro, economic, and market commentary. If I have anything to say intra-week, I'll put it on LinkedIn, Herb Morgan. Please feel free to follow me there, or on X at Herb W. Morgan. The presentation you're seeing and are hearing is designed for use with investors. It's also designed for financial advisors. Regardless, everybody is expected to make their own investment decisions. Nothing contained in the report should be treated as investment advice. There's no tax advice, no recommendation for the purchase or sale of any security. Everything is strictly for informational purposes only. The views expressed herein are mine and mine alone, may not necessarily represent the views of CFIA's parent affiliates or even other portfolio managers here at the firm. We are continuing to move through this correction phase in the equity markets. The correction is driven by two things. Number one, we started the year at very high valuations, so it's normal to expect a little bit of a pullback. But in addition to that, there's a significantly elevated element of uncertainty in the markets. Uncertainty as we transition from a command economy driven primarily by expectations, continued expectations for fiscal stimulus every time things slow down, or monetary stimulus every time things slow down. Monetary stimulus is off the table because inflation remains well above the Fed's 2% target, and fiscal stimulus is off the table because the debt to GDP that we've accumulated from prior fiscal shenanigans is excessive. And so it just can't happen. And it's helped to cause the inflation along with the over easy interest rate policy. The newly formed Department of Government Efficiency is also attempting to rein in the deficit and the debt accumulation through efficiency measures within the federal government. So we're transitioning. The government, the current administration is trying to replace the absence of the fiscal and monetary puts with enhanced CapEx or capital investment, both foreign and domestic. That is a brief summary of the transition we are in. The markets are not saying they don't like it. The markets are saying we need to adjust to it, and we still have a level of uncertainty about what the implementation tools will be to get us there, whether it's tariffs, other non-tariff barriers, etc. But having the market come down means that the earnings yield goes up. You see the pink here, the purple, as the earnings yield of the S&P 500 is now up to about 4.15%. It's getting closer to the yield on the 10-year Treasury, what we call the risk-free yield, which is about 4.28%. Obviously, the administration and the Treasury, because it's such a big expense, the interest on the debt, they really want to see those interest rates come down. But the interest rates can't come down if you don't stop the inflation. The way you stop the inflation is you don't have excessively high deficit-financed fiscal spending. That being said, stocks are a better value at the end of last week than they were a few months ago, right? The earnings yield is higher, but you're still not getting paid to take that equity risk. You need to have the purple line above the green line, like it was here all from 2020, 21, 22. And then, of course, we've been kind of overvalued-ish, slightly overvalued here for the better part of the last 3 years. So I think the correction has a little bit further to go. We also got a report last week on small business optimism. This is the metric that had shot up significantly. You see here on the right, after the election and expectations for more pro-growth economic policy in the United States came back a little of that gain, mostly because the respondents said, hey, we're really uncertain about things. And it was actually the second highest reading in series history for uncertainty. Uncertainty usually almost always means the stock market corrects. We're in the middle of that correction phase now. Not a big deal because the economy's still strong. The economy's still strong because the jobs market's still incredibly strong. Weekly initial claims for unemployment were at 220,000 last week. Estimate was 225. That's well within the range. Labor market remains very tight. We also got a report from JOLTS, Job Openings Report. that surprisingly shot a little higher, 7.74 million job openings for 7 million unemployed, total unemployed in the United States. When the number of job openings, that's demand, exceeds the supply, when demand exceeds the supply of anything, that's inflationary or the price goes up. Driving real wages higher is always a great thing. But the one thing that concerns me when I look at this graph is you see here, this was a number of unemployed had been running around 6 million, 2021, 22, and then it just started to go higher in early 2023, and we're a full million people higher on unemployment. Luckily, the growth is there, the jobs growth, the expansion of jobs is there, and it's not a big deal. But I don't like seeing that number go up at any point, and we're going to put that in the back of our memory as we continue to analyze data that comes out on a daily and weekly basis here. We got two very important reports last week on inflation. Both showed some progress, and the market sort of celebrated at the end of the week. I think that euphoria will fade later this week, maybe, or next week, as we move on to reality that a little progress is not success. This is not victory over inflation, but we'll start with the CPI. Up 0.2. The expectation was for up 0.3. It's 2.8% higher. Prices are 2.8% higher than they were a year ago. The core prices are 3.1% higher than a year ago. Fed's target's all the way down here at 2. We've got a ways to go. Then we got the PPI, or Producer Price Index, and everybody got really excited. PPI unchanged. The estimate was for 0.3, but we're still at 3.2 year over year. We need to go to 3. Core PPI, this is where it was, a lot of backslapping going on. Down. Prices actually went down. Core producer prices went down for 1 month by 0.1%. But that was on top of a massive gain in January. And the year over year here is 3.4. It was better than expected, but we're not there yet. The Fed can't all of a sudden say, great, we whipped inflation, we're going to cut interest rates this week when they meet later this week. That simply cannot happen because we have an inflation problem. It's going to take a while to work out of it. And the bond market agrees with me. This is the inflation break-even charts that I show you every once in a while. The 2-year is the blue, 5-year is the gold, and the 10-year is the silver. Inflation break-evens is real simple. You take the nominal yield on the maturity treasury that you're talking about. So in the case of the blue, we're going to take the nominal yield on the 2-year, subtract the yield on the TIP, Treasury Inflation Protected Security. The difference in between is what a very efficient market believes will be the rate of inflation over that period of time, 2 years, 5 years, or 10 years. So of the highly efficient U.S. Treasury market, where people are putting billions of dollars, trillions, I guess, to work with their investment decisions, believes that over the next 24 months, 2-year inflation will be 3.13. Over the next 60 months, inflation will be 2.51. And even over the next 10 years, we will not get all the way down here, which is what the Fed's target is, 2% inflation. Therefore, you have taken monetary policy off the table. You can't cut interest rates or expand the balance sheet if you're well above your inflation target. The Fed's job, mandated by Congress, is price stability, and we're not there. And quite frankly, I don't think the Fed can get us there just by keeping rates unchanged or even a hike. They have to get their friends in the Treasury to stop borrowing so much money, which means they have to get their friends in the Congress to stop appropriating so much money, hence this Department of Government Efficiency and their objectives to rein in deficit spending. You may or may not like it. I may or may not like it or want more spending or want more programs, but the market reality is we absolutely can't do it. It just can't be done any longer. And it appears the market is waiting to see. It's why one of the reasons the market's down. And I think the market likes what's happening, but doesn't know when it will be effective or how effective it will be. Uncertainty is what makes the market go down. And that's what it's been doing lately. University of Michigan consumer sentiment also came in really horrible. Fell from 64.7 to 57.9, way below the estimate of 63. Lowest reading since 2022. One of the 3 lowest readings in the past decade. Why? There's that word again, uncertainty. Uncertainty is the word. The word is uncertainty on policy, economy, tariffs, and inflation. That's just what's happening. We wrapped up earnings season, well, almost wrapped it up. 498 of 500 companies have reported. The earnings for the quarter, fourth quarter, calendar quarter, were excellent. 369 companies beat their estimates. 93 failed to meet their estimates, and that's great. If we're going to get rid of this chart for the next 4 weeks, and then in mid to late April we'll put this back on as we start reporting the first quarter. But this is just the S&P 500 companies. This is total corporate profits reported. This is a great metric, and I love getting it out there. This metric shows an acceleration in profit growth. You usually see it coming out of a recession. You said that rate of change, that second derivative here, steepens as you come out of a recession because you've had a profit decline for a period of time. But as we came out of the 2020 recession, we just continued to have a very steep upwardly sloping curve, and corporate profits have been growing at above expected trend in the United States. That's also one of the reasons why the market got to be so richly priced at 22 times forward earnings. If earnings are growing faster than anybody expects, maybe I'm willing to pay a little bit more for my ownership piece as a capitalist, as an investor, my ownership piece of those earnings. Now, estimates usually get cut in the beginning of the year as corporate CEOs guide analysts a little lower. They've done that, and they did it a little bit faster paced this quarter than they usually do. That's added to the level of uncertainty in the markets. We've got lots of data this week, starting with retail sales we had this morning. New York State manufacturing, I saw the number. It's horrific. We'll report it to you next week. The Home Builder Sentiment Index has a 3 handle. It's also horrific. It was reported this morning. Starts, permits, import-export prices, capacity utilization, and production on Tuesday. Wednesday's all about the Fed meeting, where the Fed will not be able to cut interest rates, will not announce an interest rate cut or a hike for that matter, but the entire industry will be fixated on the statement and the directionality and the expectations that they give to the markets. Jobs claims Philly Fed, home sales on Thursday, and nothing major scheduled on Friday. Of course, Thursday and Friday we get into the NC2A March Madness basketball tournament, which we'll all be fixated on for the next month or so. Hope you enjoyed the weekly podcast. It's a podcast, but it's also a video on the YouTube. Go to the YouTube and type in Slaying Bulls and Bears. My goal is to make the complex and complicated simple and sensical. This is available also as an audio podcast on all the audio podcast formats. Thank you for tuning in. I look forward to coming back to you again with great information 1 week from today.